On April 2020, the price of oil plunged into the negative territory for the first time in recorded history. But did it really plunge into the negative territory? Well, in this video, I'm going to explain everything about it and also about derivatives. So you will be understanding all the basic kinds of derivatives and also about what happened to the price of oil in this video. So if you are new here, my mission is to empower you with the tools that you need for self-study. So if you want to join in that journey, please subscribe to my channel and also do not forget to ring the bell icon so that you, my friend, do not miss any future notification. Let's get started. Hi, this is Shubhpriyo. So we are going to talk about financial derivatives today, and we are going to see how these derivatives are related to the price of oil and the historic movement of the price of oil that we saw recently. Before we begin, I want to give you an important disclaimer. So I have written financial derivatives over here, but actually in finance these things are called derivatives, and in some books you might find that they are written as financial derivatives, but it is done to actually differentiate them from commodity derivatives. So financial derivatives are actually based on the things which are only financial objects, and commodity derivatives, they are actually things that we can actually feel, we can actually see. So for example, the things like wheat, like metals, those are the commodity derivatives. So we have financial derivatives and we have commodity derivatives, and also I have titled this video as financial derivatives and I have written it over here so that school के बच्चे इधर ना आ जाए और ना सोच पड़े कि इधर मैथ्स पढ़ाया जा रहा है. No, that is not what we are covering. We are covering core finance concepts. So let's begin. The financial derivatives. So first I want to give you an overview. Now what are financial derivatives, or what are derivatives actually? So derivatives, they are financial contracts, very important, financial contracts whose value is derived from an underlying asset. So very important, they are financial contracts and their value is derived from an underlying asset. And the third thing is that their price is going to be settled at a future date. So in a nutshell, they are financial contracts between two parties, the value of which is derived from an underlying asset, and the settlement, it occurs at a future date. So you and I, we can get into a derivatives contract and I can say that this will be the price at which I have to buy that thing from you in the future. So the buyer of the contract says that I will buy from you, and the seller of the contract says that I will sell to you. So we'll look into these things a little later when we cover the types of derivatives. So this is the main concept of the derivatives. Remember that it derives the value from an underlying asset. So by itself, the derivative does not have any value. So you can ask, what can the underlying be actually? So what are the things which can be used as underlying assets for our derivatives? So we can use shares, we can use bonds, we can use commodities, we can use currencies, we can use even interest rates, and we can also use mortgages, and we can even take indexes. So there can be various kinds of underlying. It has to be an asset, so that underlying asset will be the basis upon which we will be building our derivatives. Now the next thing is, what are they actually used for? So there are three primary uses of a derivative, and the first use, it is for hedging. Now what does hedging actually mean? So hedging is kind of an insurance, you can say. Hedging means that I have a risk and I want to reduce that risk. So that is how we are doing hedging. Now if you want an example for hedging, so for example, I know that the price of dollar, like the price of dollar, it actually fluctuates, right? So consider that $1, it is right now around 76 INR, right? So around 76 INR we can give to get $1. Now I feel that the price of dollar, it will actually appreciate, and the price of this currency, our Indian currency, it will depreciate. So what I can do, I can go into a derivative and I can reduce my risk, I can hedge my risk. I can say that okay, I will be getting this amount of dollar at that point of time after a certain amount of time. So for example, I will be agreeing to take delivery of the dollar for 77 rupees. If I can fix that, so I have hedged my risk, because the dollar can go up to even 80, it can go upwards of that also. So I have hedged my risk because I have just reduced my risk. I have of course paid some price. So when you are hedging your risk, you will have to pay some price. So that peace of mind that you get from reducing your risk, you have to pay a certain amount for that, and that is how you are hedging your risk. So this is what hedging really means. And the second thing that you can use the derivative for, it is for speculation. So what kind of speculation are we talking about? So for example, there are two primary things. So there is something called a bullish sentiment, and there is something called the bearish sentiment. Now what is the bullish sentiment? So bullish sentiment is when you are expecting that the underlying asset on which we have made the derivative, if the value of that is going to be rising, so your sentiment is bullish. You are expecting that the price will rise, so you can make a bet based on that, and if you are proved correct, then you will be getting some profits. So that is what is called speculation. Now if you are bearish, if you feel that the value of that asset is going to go down, then you can just go ahead and bet against that asset, and then if the value of the asset actually falls, then you will be getting some profit out of it. So that is the speculatory part. So hedging we understood, and speculation also we understood. There is also a third thing which the derivative is used for, and it is called arbitrage. Now arbitrage, this is very interesting. See that when you are hedging, you have to pay a certain amount, and then you are reducing a risk. So that is how hedging works. Now for speculation, you might get a lot of loss, you might get a lot of profit. So it is kind of a gambling. It is kind of a thing that you are taking a bet. But arbitrage, very, very important. In arbitrage, you will never take a loss. So it is a riskless kind of an investment strategy. So what does arbitrage actually involve? So arbitrage, in that what you use, you actually operate in two markets. So the things that we are talking about, these are in the derivatives market, and there is also something called the equity market. So that equity market, it actually operates as a spot market. So if you have certain kind of an investment idea in which you can use these two markets and you can profit no matter what happens, then that is called an arbitrage. So I will just give you a small example. So what happens, for example, if you found that in the spot market there is a share which is priced at rupees 100, so you have taken that share, you have bought that share. Now what you find that there is a derivative contract, say there is a futures, we'll get into that a little bit later. So for example, just think that there is a derivative with a price of 150. So 6 months from now, you can sell this share for 150 rupees. Now if you have taken that share from the spot market, and then in the derivative market you are selling that share after 6 months, so this is a guaranteed profit, because your buy price was 100 and your sell price is going to be 150, and that is how these arbitrage things actually take place. So you are using the price differences in two markets and manipulating that so that you can have a guaranteed profit. So it is a riskless guaranteed profit in arbitrage. And of course arbitrage is something that very experienced players get into, and it is very difficult to find arbitrage opportunities right now in the market, because the markets are quite deep, and the pricing is also quite correct. So just know that this is something that people get into derivatives for. And so what are the main types of the derivatives? So there are four primary derivatives. There are forwards, there are futures, there are options, and there are swaps. So we will be covering in this session all of these four types of derivatives, and I'll be also talking about the price of oil when we come to the correct derivative involved in that. So why should you care? Now this is also something very interesting, that why should I care? Now you should care because all of the major market movements involve derivatives. I'll give you an example. So for example, think that your mortgage payment, you have taken a home loan. What if somebody could actually profit based on your home loan? Yes. What can that be? Actually, it was done in the global financial crisis 2008. So GFC 2008, something like this was actually done. So the mortgage payments that you and I are actually paying, those mortgage payments were actually bundled and a financial instrument was created, a derivative was created, so that the big banks could play with that derivative. And that is how we got ourselves into a crisis. And I'll give you another example. So for example, have you heard about the Black Wednesday of 1992? It was the time when the British pound took the worst fall in history in 1992, and that was also done under speculative movements and derivatives were involved. So derivatives, especially when they are used as speculatory investments, they can actually impact the life of you and me. So we need to understand everything about derivatives and we need to be informed. So let's move to the next part and we'll talk first about the forwards. So forwards are what we call OTC derivatives, or over the counter derivatives, OTC. So mainly there are two types in which we can get into a derivative contract, and OTC is one of that. So OTC means over the counter. So this means that you and I, irrespective of if we are regulated, if we are in some common jurisdiction, we can get into a derivative contract, a forward agreement, and we can just decide between ourselves what we want to pay, how we want to contract, and etc, etc. All of those things we can, both of us, decide. So this is called over the counter or non-exchange traded derivatives. So these derivatives, they are very risky because they have something called the counterparty risk. So this is the risk that what if I do not honor the derivative or you do not honor the derivative. So this is a big risk that we have in the forward derivatives because they are all OTC, and there is also a different type that is called an exchange traded derivative. We'll get into that a little bit later. So those are done using clearing corporations or exchanges. So first let's talk about the forwards. It is not standardized and no intermediary is there, of course, because you and I, we are doing this off the books, and there is nothing that stops us from signing fully customized agreements. So what actually happens in a forward agreement? The buyer and the seller, they get into a contract, and what is actually stated in this contract? In this contract, it is stated that the buyer will be buying an underlying asset from the seller at a predetermined price and at a predetermined date. So you and I, we will be getting into a contract. So for example, if you are selling that and I am buying it, so very important to note is that the buyer, he has an obligation to buy. So I have an obligation to buy from you. At the moment that the contract is finished, that the date comes, I cannot tell that okay, now I don't want to buy. That will not work. So there is an obligation to buy. I am obligated to buy that thing from you. And seller, so the seller has an obligation to sell. So you who are selling it to me, you have an obligation to sell it to me. So this is very important to understand. This means that neither of us can ever escape from this agreement, and we have an agreement. So at that date, so for example, we can say that if we get into kind of an agreement where we are purchasing shares, so I can say that okay, X company's shares I will be buying from you at rupees 100. So I will be giving you rupees 100 to buy that share from at 6 months from now. So 6 months from now, I have to buy that share from you at 100 rupees, and you 6 months later have to sell that share to me at 100 rupees. So this is how this forward agreement actually works. And remember, there is no intermediary involved. So it is just you and I that we are discussing over the counter, and we are creating this contract. So a very important thing is that it is a zero-sum game. So I will be explaining a little later the graphs. So when you see the graphs, you will be understanding why it is a zero-sum game. So the main fundamental why it is called a zero-sum game is that for me to make profit, you have to lose, and for you to make profit, I have to lose. So somebody has to lose money. There is no extra wealth that is being created. Only we are getting into a contract, and if the price rises or the price falls, accordingly we will have profit or loss. So this is how it works, and there is no situation in which both of us will be happy. Either one has to be happy and the other has to be sad. So that is why it is called a zero sum game. And there are some terms, so remember the terms. So what is the spot price? The spot price is the price of the underlying asset, the market price of the underlying asset. So the spot price, it keeps on changing from day to day. And what is the future price? So the future price is the price at which we have gotten into the contract, and the price at which I am going to buy, the price at which you are going to sell. And there is also the lot size. So lot size or contract size, this means that the amount of the contract, the amount of items. So for example, we are talking about the shares, this 100 rupees after 6 months. So if I tell that I am going to buy 1000 shares at 100 rupees from you, that means that the lot size is 1000. And we also have the contract value. So contract value is the multiplication of the lot size into the price at which we are getting into the contract. So that is the actual contract value. And of course the duration, the 6 months that we talked about over here, that is the duration. So that is all about the forward contract. And next we have to go into the futures contract. Now very important thing to remember is the futures contract, it is exactly the same as a forward contract. So there is no difference between these two contracts, except that futures, they are actually what you can say standardized agreements, and they always involve an intermediary. So they are exchange derivatives, or you can say exchange traded derivatives. So these derivatives, you always need an exchange in the middle. So for example, if you and I am again the buyer and you are again the seller. So if we need to get into a futures contract, then directly we cannot go and interact. We have to approach a clearing corporation, and that clearing corporation will be the intermediary. So this actually what happens is, it is very standardized and it is regulated. And remember that because there is the involvement of a different entity, we have to pay the exchange the margin money. So without a margin money, we cannot enter into a futures contract. We have to pay the exchange some money, and that is the margin money. So very important is that there is no counterparty risk, of course, because that exchange, they have decided that they will be playing the role of a middleman. So there is no counterparty risk. I can freely get into this agreement and I don't have to worry that whether you are going to pay. You have to pay. So how this actually happens is that the intermediary, you can see that they will be in the middle, the intermediary, and here this is me. So I will be getting into a contract, and this is you. So what happens is that when we are going into this agreement, I have to pay some money to the intermediary, and you also have to pay some money to the intermediary. So they take an initial deposit, and the deposit that they take, ultimately what happens is when the contract is over, somebody profits and somebody loses, right? So the intermediary will be paying back me, and the intermediary will also be paying back you. So the person who has been profiting, they will be getting the more money, and the less money will be given to the person who has lost. So this is how this actually works, and the entire thing is similar to the forward. So nothing else is changing. And now we have to go into the very interesting thing, that what is a long position and what is a short position. Now for this I will be showing you some graphs, but before I want to tell you what are these long positions and short positions in the equity market. So in the equity market and the derivative market, the definition of these things is varying actually. So in the equity market, if I hold a share for a long amount of time, if I think that the share price is going to go up, then I will be holding it, right? Because later on in the future when it goes up, I want to sell it. So that time I am said to be a person who is holding a long position. So I will be holding the shares for a long time. And what is a short position? Short position is something that we call as shorting or short selling. So I have already talked about this in a previous video. So short selling, what happens is you basically borrow shares that you do not have. So if you think that the share price is going to go down, so what you do, you will be borrowing some shares from somebody, and immediately you will be selling that in the market. So for example, 100 rupees you are going to sell it in the market, and then you are thinking that the price will go down. So if the price goes down, if it becomes 80 rupees, you buy it back from the market, and then the person to which you had borrowed, you return that share. So that is how short selling actually works. It is a very highly leveraged kind of a thing, and very risky for normal traders to get into it. So that is something, the main difference in the equity scheme, in the equity market. But in the derivatives market, what happens? So I'll show you a graph, and then you will be able to understand this a bit better. So this is the graph. This is is the long position that we call long position in a futures derivative. So always remember, the person who is buying, who is getting into the buying side of the futures contract, that person is in a long position. Why? Because the long position person is thinking that the price will go up. If the price goes up, the buyer will be profiting, and the buyer is the guy who is in the long position. So now that you understand that basis, I'll explain the graph. So what is happening in this graph? You have on the y-axis a payoff. So this is your payoff, the amount that you have earned, and on the x-axis you have the underlying price, which is determined by S. This is determined by P. So what happens when the underlying price, it actually keeps on increasing? There is a point of time when you get to a break even. So when your delivery price, which is X, so X is actually the delivery price. So it is the price at which you have decided to get into the contract. So 6 months after that, as I told you, the 100 rupees per share, so that is the X over here. And when the price of the underlying asset, it actually keeps on rising, what happens? The payoff of the buyer, it goes up. So as you can see indicated by this red line, if the underlying price will keep on increasing, the the upside that we can get, the buyer can get, it goes up. So here, this portion of the graph, this is the profit. So this is the profit that the buyer of the futures derivative will be getting if the price keeps on increasing. So as you can see, the profit potential is actually unlimited. So this is an unlimited profit potential, and there is something called the payoff. So the payoff, as we say, the payoff is S minus X. So the price of the underlying minus the delivery price. So if the underlying price, this goes up and up and up, so this actually indicates that I will be getting lot of more profit. Now why am I saying that it is a profit? Try to understand why I am saying this. So I'll take the example of a share, for example. So consider that the share, we got into an agreement that I will be buying it from you, as I told you, at 100 rupees 6 months from now. So 6 months from now, I will be buying it from you at 100 rupees. So this 100 rupees, this is actually what? This is actually X. So I have told that I will be buying the share from you at 100 rupees. Now see, if the underlying price keeps on increasing, if it goes to 120 say, so now the share price in the open market, it is 120. What will happen? I will buy that share from you at 100 rupees, and then what will I do? I will sell that share, of course, in the open market for 120. So 120 minus 100, 20 rupees per share is my profit. So if the price keeps on increasing, I will be profiting. So that is what the long position entails. So this is the buyer side of the equation. So I hope that you understand now what is the long position. And now let us talk a little bit about the short position. So this is the short position, and remember, short position means that you are seeing the graph from the perspective of the seller. Very important. So short position is the seller's position. Very important. The same graph is over here as well. So we have P over here as the payoff and the underlying price X. Now this red line over here, what does this indicate? This indicates that if the price is going down, so if the underlying price, it actually goes down, what happens? That the short position, the seller, the payoff will be X minus S. So this is the delivery price minus this underlying price. So if the underlying price, it moves in this direction, what will happen then? And of course, remember the quadrants of the graphs. So this is the positive quadrant and this is the negative quadrant. So if the underlying price decreases, what happens? I have this amount of profit. So the seller, he can get a profit of this amount, this region in the graph, if the underlying price becomes lesser than X, which is the delivery price. Now if the price keeps on increasing, what happens? See this part is the seller is in loss over here because the underlying price has risen quite high and the X is the delivery price, so it has overshot the price of X. Now that is why we say that the payoff is X minus S. So this is the payoff in case of a short position. So very important, your the potential loss that you can get in this kind of an arrangement, the seller can get the loss. It can be infinite. See, it can be an infinite loss because there is no limit up to which the underlying price can be contained, right? The share price can go 1000, 2000, it can go anywhere. So if that happens, then the seller is going to be losing, and that is why we have this graph. Now very important, remember these two graphs that I told you, because sometimes in the examinations they will be giving this graph to you and they will be telling you to say what kind of a thing is this, is it a long position or a short position. So I hope that you understood exactly what these two positions actually entail. Now let us get back here. So you understood who has the long position and who has the short position, and I also explained to you the long position payoff, which is S minus X, and the short position payoff, which is the X minus S. So these two things you have to remember. And of course the unlimited profit and the loss potential, this is also something that we could understand very well from the graph. Now we are going to get into the thing that you have been waiting for, which is the price of oil. So the story of negative oil, what is happening over here? Is the price really negative? So the first thing you have to understand is that there are various oil benchmarks. Now why is there so many benchmarks for oil? What happens is that oil, whenever you are selling it in the global markets, there is a difference in the quality of the oil, and different components, different people need different qualities of the oil, and so these benchmarks, they actually help us to understand what is happening in the price movements, the trend, and also about the quality of the oil. So there are various kinds of things. So there are three main benchmarks that you have to remember. So the first thing is the West Texas Intermediate. So this is the WTI index. Then we have the Brent crude. Then this is actually the oil from the North Sea. And the third thing is Dubai crude. So there are three primary oil benchmarks that you must remember. Now remember basic economics. What happens when the demand is down and the supply is up? So why you have to think about this? Because in the current situation, what has actually happened? The demand is down by a lot. Why is that? Because right now we are dealing with the coronavirus. Now remember that whatever we are consuming in the economy, no matter if we are consuming vegetables, if we are consuming fruits, whatever it is, there is the requirement of oil, because transportation requires oil. So nothing can get to anywhere in the economy without oil being there. Transportation is very important, and of course the economies are totally dependent on oil. We have to put it into our cars, and it is the main fuel for the economy. Now what's happened here is that because of the coronavirus situation globally, people are not going out of their homes, businesses are closed, there have been so many layoffs, and there have been so many shortages in the essential items as well. That is why there is a very low demand for oil at this point of time, because people are not moving around and transportation is closed, trains are closed, planes are closed. So all of these things, they have caused what we call in economics a demand shock. Demand is drastically low, and at the same time that demand is low, the supply is up. Why is the supply up? This is because oil prices globally, it is a very complicated kind of an arrangement. So in this video, it's not possible to explain everything. Just remember that the major producers of oil, they are the OPEC countries. The OPEC countries, Russia, USA, these are the major producers of oil. And what happens is all these different jurisdictions, they have to agree to price cuts, and they have to agree to a cut in their production so that the supply can go down. But what is happening right now? The demand is down, but the supply side, what is happening? Many countries are objecting. They are not sure if they want to cut production. Now what is happening? Because there is not a central regulatory thing, many countries are thinking that okay, if I am going to cut my production, and for example country X does not cut, then country X is going to get so much advantage, right? Because I will be lowering my production, but that country will not be lowering it, and what will happen in the end? That country is going to profit, right? So I cannot let that happen. I will not cut and let that country cut first. This is kind of a kindergarten kind of a situation that's happening in the world, and what has actually resulted because of this is that the supply, it has actually not been reduced that much. So, and on April 9, what happened? There was a big meeting, and in that meeting also they have finally agreed for some cuts, but because of a standoff with the Mexican government, what happened was that the cuts, they had not started, and they will be starting those cuts only from May. And till now the demand is down, but the supply is going up and up. So what is the basic economics telling us in this situation? In this situation, the price of the commodity will fall, right? Because there is no demand and there is an oversupply of this commodity. So oil is oversupplied in the entire world at this point of time, and so the prices have crashed down. Now, importantly, remember that when we are talking about negative oil, we are talking about oil futures being negative. Now, why is that? This is because this WTI that I am talking about, this WTI, it does not actually reflect the price of the physical product, but it actually reflects the movements and the sentiment towards oil futures. So this index, it actually measures oil futures and not the oil price. Now, why is this? So if you had seen in the previous thing that we were discussing, I'll show you. So this is the interesting thing that we had talked about, futures being marketable. So futures are marketable. This is the key important thing. What is happening over here is linked to this marketable nature. So because futures are marketable, what happens is these future contracts, they will be changing hands. So they will be traded at the stock exchanges, at the clearing corporations where they are actually transacted. So what happens is these futures, so this WTI, it is tracking these oil futures, right? And these oil futures, they are getting traded. Remember, we can trade those future contracts. They do not have to be at one hand only. Now what has happened, because the demand is down and the supply is up, what is happening? A lot of oil is getting stored right now, and the companies, they are running out of storage space. Now remember that these oil futures that I am talking about, futures, what does it actually help us to do? So take our example of the shares. So we are trying to actually lessen the impact of volatility of the prices. So what happens in the oil futures? The big oil companies, they will be taking delivery from the crude oil manufacturers, and what will actually happen here is that, for example, they in the previous months, they had told that okay, I will be taking one barrel for $50. So that is what they had told earlier. Now at the point that this is going to expire, the contract is going to expire, the price of oil has actually fallen so low that if they are going to be taking the delivery of this oil at $50, they are going to have a massive amount of loss. And not only that, the main important thing is that these companies who were supposed to take the delivery in these oil futures, the delivery of the oil, these people are running out of storage space. So they do not have any space to put the oil. So where will they put the oil? They do not even have a place in which they can put the oil. So this is the reason that these oil futures, what will be happening on April 20, we saw that big collapse, right? On the very next day, it was the expiry date of the oil futures. So because on Tuesday, those oil futures, they were going to get expired. So at that point of time, they had to take delivery. And if they did not take any delivery at that point of time, there would be massive consequences. And this is why what the energy companies did, they basically went to the market and then they started to just offload these oil futures. So these future agreements that they had, they kept selling to people, and even it went so bad that they actually offered money to these people. So they started to offer $20, $30, and this is why ultimately, see, they will not be offering more than $50, right? Because this is the price that they were supposed to pay. But they have actually kept on and on and on. And finally, what happened was that these oil futures, these energy companies were actually paying others to take it off their hands so that they do not have to take delivery of the oil. So the oil futures, they became negative, but only for the May delivery. So only for the month of May, the delivery that was to be at the month of May, these have become negative. So they have plunged minus 321% to 37.5 $0.63. So this is the amount at which they had finally stabilized, minus $37.60 per barrel of oil. So you can understand this has actually happened because they do not have any storage space. Now these are the oil futures, so the tradable oil futures. Remember, this is not the price of oil. So this is not the oil that you are putting in the car. This is not the oil in which the economy is running. This is the oil futures. So this is what actually happened, and that is why we had the negative oil futures. And this is the main distinction. Oil was not negative, but the oil futures for the month of May were actually negative. For the month of June, well, the good news is that for the month of June right now they are in the positive territory. So what does this actually indicate? This indicates that in June they are expecting that the demand will slowly climb up and the supply cuts will also get into place. So then the price of oil will be stabilizing and finally the people can take delivery. So this is why actually these all things happened. And also importantly, remember this, that there was an increase in the Cushing stockpile. So there is a city in USA called Cushing. It is one of the important key storage hubs for the US oil, and they have a storage capacity of about 91 million barrels. And people were saying that within the next month this place will be running out of storage because so much oil was getting there and they did not even have a space to keep the oil. And important thing regarding what is the consequence for India and other high current account deficit nations. So people who are net importers of oil, we are going to get a lot of boost because of this, because the oil prices will be getting even lower, and this will help India to get delivery of oil for a very cheap price. So this will actually help our current account deficit and even for the countries which are running a negative current account deficit. So this is actually the story of negative oil. Now let us go into options contracts. So now we come to options contracts. So options contracts, the principle that we have understood in forwards and futures, same kind of principle is there, but there is a twist here. So the twist is in the name of the contract. So what is the name? It is option. So you have an option here. So therefore you have a right but not an obligation. This is very, very important. So you have a right to buy or sell, but you do not have an obligation. So you are not obligated to do that. Now remember that mostly options are only exchange traded derivatives. So they are traded on the exchange usually, but sometimes some exotic options are there which are traded in OTC fashion. And always when you want to go into an options contract, you have to pay an option premium. So option premium means the money that you have to pay upfront to get into the contract. So this is the money that you pay before even getting access to that contract. So this is something that you have to spend to get into the contract. Now very important that options contract, they had actually evolved because the people wanted to restrict their losses but maintain their unlimited profit potential. So if you want to hedge and you want to restrict your losses while you want to maintain the unlimited upside potential, then you go into an options contract. So what happens? There are two primary kinds of options contracts. So there are call options and there are put options. Now how do we actually remember this? So you can use a very interesting analogy. You can think of a telephone receiver. So think that you have a telephone receiver and you are calling somebody. So what do you do when you are calling somebody? You are calling to buy. So you might call your stockbroker to buy. So call options means that the buyer of the call option, he gets the right to buy at the predetermined price at the predetermined date, but he does not have the obligation. And what is the put option? The put option means that the person who purchases the put option, he gets a sell right. So he has a right to sell that underlying asset at that price at that point of time in the future, but he does not have an obligation. So put, you can think of that you are putting down the telephone receiver, and that actually helps you remember what a put option actually is. So call options buy, put options sell. This is a very important distinction between these options. And there is something called the strike price here. So strike price means the price at which you had agreed. So the price at which you are going to exercise your option, that is the strike price. So if I have decided, so let's take the same example. So we had decided that I will be buying I will be buying a share at rupees 100 6 months from now. So our my strike price, it is 100. Now what is the spot price here? Spot price is actual market price of that share. So actual market price of the underlying asset of the security, whatever it is. So the market price is the spot price. So at that point of time in the future, the spot price can be 120, it can be 80, it can be anything, but my strike price, it remains at 100. So this is the main distinction. And there is another thing that you must remember, which is the difference between European and American options. So European options, the main thing is that European options allow you to exercise your right only on that date, on the date of the expiry of your contract. So on one date only you can exercise your option to buy in case of a call option and your right to sell in case of a put option. So only on one date you can do. But American options, what they do, American options, they actually allow you to buy or sell up until that date. So any day up till the date of expiry of the contract you can do. So it is on a running basis, you can say, and European, it is only one time. So keep that in mind. And let's move to the main distinction now. So distinction between the call and the put options. So the call options and the put options, this is something that you cannot actually think of logically. You have to just mug this thing up. You have to remember this. So remember that the buyer of a call option, he is holding a long position and the seller of the call option is holding a short position. Same way, in a put option, the buyer of the put option, he is in a long position and seller, he is holding a short position. So this positional aspect, always just you have to mug this up. There is no way to remember this. There is not some kind of a logic here. Just remember, buyer in both the cases in long position and seller in both the cases is in short position. So I'll show you a graph that you will be able to understand better. So as you can see over here, this is the payoff for the long position. By the way, this part of the graph that you can see, this is the call option and this is the put option. So we are actually studying the payoff between these two options. So the same thing follows like we saw in the last graph. On the y-axis we have the payoff, the P, and on the x-axis we have the market price, so the price of the underlying. So remember that I have decided to buy at 100 rupees. That share I have to buy at 100 rupees, and after 6 months I will be buying it. So this is the main fundamental here. So remember that. And now let's just see the graphs. So here you can see that the graph, it does not have an unlimited loss potential. The loss potential is limited over here. So what is this part of the graph? This part of the graph is your premium. So this part of the graph, this is your premium. Now why is this? Because as I told you that when you get into an options contract, you have to pay a premium. So that premium you have already paid. So what happens here? Just try and understand. You have a call option. This means you have the right to buy. Okay, so when are you going to buy that? When the price rises, of course, right? Understand what is actually happening. If the price of the share, it becomes 120. Okay, the price, the spot price is 120 and your strike price is 100. So what you will do, you will exercise it. So you will buy at 100 rupees, and in the market the rate is 120. So you buy at 100 rupees and you sell at 120. So you will make a profit of 20 rupees. So only when the price is going up, that is the time that you will be exercising your option. This is called exercising the option. So the premium, when the price is actually going up, this is the negative. So this is the negative payoff over here. If the price goes up, then you have an upside potential, and this can be an infinite upside potential. If this price, it goes to 1000, then what happens? Then you can get even a lot more amount of profit, right? So this goes to the higher end. So this is the payoff for the long position. This is the payoff for the buyer of the call option. So I hope that you understood this graph. Now let's come to this graph. We have the payoff for the short position. So for the short position, this is the person who has actually sold this. So for the seller, what will happen? He will be in the profit. This is the premium. This is the premium, same thing. This is the premium that the seller has actually acquired from the buyer. So this part of the graph, until the market price goes high, if the market price is low, it is towards the left of this, then I will not be exercising that. So the seller, he will actually be profiting. So this part is the profit of the seller. So if the market price goes up, if it increases, then what happens? Then if it goes here, then there will be an exercise of the option, and when it is exercised, then there can be an infinite loss potential. So you can see over here, there is an infinite loss potential for the seller. So for the buyer, you do not have an infinite loss, but for the seller, you can have an infinite loss. So this is the kind of graph that you have to understand. So basically this is just a mirror image of the previous graph. And the break even price, now the break even price is the strike price plus the premium. Of course, because I have already paid some premium, then the strike price plus the premium I have to make, right? If I can make that, then I have break even, and after that, even then, if the price is rising, my option, I can say it is called in the money. So there are three terms. There is at the money, there is in the money, and there is out of the money. So if the break even I have less than break even, it is called out of the money. If I have more than break even, it is called in the money. And when it is at the break even, it is called at the money. So similarly, if we see over here, now let us just think of this thing. So let us see that right now, this is the put option, right? So this is the option where I have a right to sell. I do not have an obligation to sell, I have a right to sell. Now see what is happening over here. Long position means that the buyer, so the buyer of this put option, so me, who has actually gotten the right to sell. So when will I be selling? I will be selling only when the market price is less, right? If the market price over here is 80, okay, then what I will be doing? So I will be exercising this put option. Why? Because I can actually buy the share from 80 rupees in the market. I will be buying it and I will be selling it to you at 100 rupees. So this is why when you have this portion of the graph, this portion of the graph indicates that the payoff for the long position, this is the positive side. So this is the profit side. And then as the price keeps on increasing, if it goes to 100, then 110, 120, of course I will not be exercising it because it is becoming more and more expensive. Now that is why at this point of time I will not be exercising it, and then I will have a flat line over here. This is my maximum loss that I can have, because the maximum loss is my premium, whatever premium I have paid to actually get into this arrangement. So this is the payoff for the long position, and similarly, just a mirror image, the payoff for the short position. So think now of the person who has actually sold this put option. So if the market price is quite low, what will happen? The buyer is going to exercise. If the buyer exercises, what happens? The seller loses. So see, this is the loss that the seller is actually having. But now if the market price is going up, what will happen? Then the exercise will not be actually happening. So the put option will not be exercised by the buyer, and that point of time the seller is going to profit. So you can see this is the maximum profit. So the maximum profit is limited to your premium, whatever you have gotten over there. So that is the main difference between the call option and the put option. And here also you can see a formula, BEP equal to strike price minus premium, because you have to subtract the premium from it. It is actually quite normal to understand. And very important thing, that here also you have in the money, at the money, and out of the money. So just similarly, as I explained, the same thing is going to just be applicable over here. So it is quite clear that how we are exercising our options contracts. So let's move to the next part. So this is the final part of the video, which is the swaps. So swaps are always OTC derivatives. They are not exchange traded. Always swaps are informal contracts. So the big companies, they are usually getting into swap agreements. And what happens here? There is an exchange of the cash flows or of interest rates. Now swaps can actually help by exchange of the cash flows or interest rates. So mainly what kinds of swaps do we have? We have the currency swap and we have the interest rate swap. So what happens in a plain vanilla interest rate swap? In a plain vanilla interest rate swap, what happens is sometimes it will happen that an entity, they are paying fixed rate of interest, and another entity, they are paying a floating rate. Now what happens, that one entity thinks that okay, this fixed rate of interest, I will be actually willing to pay that fixed rate of interest, because I feel that the interest rates, they are going to go up and my payments will actually increase quite a lot, so better that I pay the fixed rate. And this party, they feel that no, the interest rates, they are going to go down, and so I am going to profit if I take that. So what they will do, they will actually just exchange their interest rates, and their interest rates the other person is going to pay. So that is what is called the interest rate swap. And then we have the plain vanilla foreign currency swap. Now foreign currency swap, what happens in this? For example, there is a company in America and there is a company in Europe. So in the European company, say for example in UK, they want a loan in dollars, but if they go to their local bank and ask for a dollar loan, they will have to pay a very high amount of interest. And this company, they want a loan in pounds, but if they go to the American company, they are going to pay very high. So this is why they decide that they will be exchanging their principals and their payments. So the currency swap happens like this. So they are going to basically swap their currencies. So this company, they get the dollar loan, this company, they get the pound loan, and they can just work out an arrangement so that at the end of the period, the principal will be exchanged back and then everything will be nullified. So foreign currency swaps and interest rate swaps are sometimes often used by governments even. And you might remember that in 2018, India and Japan had actually signed a foreign currency swap agreement of $75 billion. So these kinds of agreements are very, very beneficial because they help to actually hedge the risks. So this is how they are actually used. And there is also something called a credit default swap. This is actually something that insures against non-payment of a bond issuer, and CDS, credit default swaps, played a very integral role in the global financial crisis. Here I will explain everything about credit default swaps. I hope that you have learned something from this video and that it was beneficial to you. If you like this video, please leave a like and please subscribe to my channel, and also click on the bell notification so that you do not miss any future update. I'll see you in the next one. Bye bye.